one of the main drivers of demand are these sort of non-correlated, non-economic demand drivers, and that's something that has allowed self-storage to be, fairly recession resilient. One other thing is from a landlord perspective, there are very favorable protections for landlords, but in the storage world, landlords can simply, through the lien rights that we have on the contents of the unit, simply auction the contents, and the unit is back in inventory the next day.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. I am one of your co-hosts for today, Nathaniel Leach. I have my other co-host, Tim Bickmore. Our other partner, Dan Weiss, is taking a well-deserved day off. And today we have as our guests, Joe Austin and Lloyd Hussey from the William Warren Group. So just going to read off some quick bios, and then we're just going to jump right in. Lloyd is a managing director on the real estate team and provides management oversight to acquisitions efforts nationally. In his role, he works with our regional acquisitions teams to source, underwrite, and close value-add self-storage property acquisitions. Additionally, Lloyd works closely with the executive team on the management of the WWG Storage Income Fund. Prior to joining the William Warren Group, Lloyd was the Acquisitions and Asset Management Director of Christina Real Estate Investors, a Los Angeles-based real estate private equity fund with diverse holdings in retail, office, residential, and mixed-use assets. Lloyd earned a dual MBA Master of Real Estate Development degree from the University of Southern California and an undergraduate business degree from Georgetown University. He is a licensed California real estate broker, a chartered alternative investment analyst, and a member of the Urban Land Institute. Joe, as a vice president of capital markets, Joe oversees the company's capital raising and formations efforts. The capital markets team is in charge of identifying, securing, and structuring capital for acquisitions. Prior to that, Joe spent 13 years as a film finance agent at Endeavor. While at Endeavor, Joe helped secure over $75 million of production financing and secured distribution for over 40 films. From 2016 to 2017, Joe was based in Beijing, where he helped launch a joint venture with Tencent, Sequoia Capital, and Focus Media. Gentlemen, welcome. Thanks for coming.
Thank you, guys. It's a pleasure to be here.
Thanks for having us.
Well, with that, we're just going to dive right in. So this is our first question. So as we said before we started to record, just going to throw the question out there, and then you guys just run with it. You choose. So our first question for this evening is, how is self-storage real estate different from other types of real estate investments?
You want me to take this one, Lloyd?
Sure, I can chime in too as we go.
Sure. Well, it's a great question. Self-storage is it's a wonderful utility that almost everybody has a potential use for, given our propensity to acquire things, right? And it is typically used in cases of we call it like life-changing events, right? So it could be death, divorce, moving across the country. And so the real estate itself sort of has this flexible utility for almost any type of person. A good portion of our tenants are also small businesses. So there's also that component as well. And then in terms of its comparison with other asset classes, what's interesting is, it has very light capital expense. So whether you're doing, acquisition, whether it's light value add or core plus, it typically is relatively easy to operate, right? They're it's not quite for walls and a ceiling, but you know, they're closets for things, stuff, assets. So there's not a ton of infrastructure necessarily. And then of course, leasing structure. So leases are month to month, which is dynamic because, you know, in terms of like, if you have a triple net lease, that's a decade long, that has its pluses and minuses, right? You get a great tenant, you know, for the next 10 years, you've got somebody secured who's on the hook for that. At the same time, where we have all these macro economic sort of changes happening right now, as we can see, both from inflation, interest rates, right? What's nice about self-storage is that every month you have the ability to increase rents. Lloyd, I'm not sure if you want to chime in with some more color.
Those are great data points on the sector. You know, it is unique in the sort of spectrum of property subtypes in a lot of ways. One of the things Joe started out with was the fact that storage, oftentimes demand for storage, is generated by non-economic drivers. You know, so I think Joe called them life-changing events, but it's true. Storage is a sector that, in part, there are many use cases for self-storage, but one of the main drivers of demand are these sort of non-correlated, non-economic demand drivers, and that's something that has allowed self-storage to be, you know, fairly recession resilient. So as a sector, it's not super correlated. And this is kind of known just anecdotally, but also it's, you know, it's something that can be proved out and demonstrated with empirical data by looking at how the sector performs in various market cycles. But the conventional wisdom is that it's recession resilient because a large part of the demand underpinning the sector comes from these non-economic sort of life events. So, you know, think about the death of a parent, the liquidation of an estate, the children get together and empty out a household, and that stuff goes into a unit, a 10 by 20, for a year or two or three. You know, a family moves cross country and that's a longer term use. And then there's sort of a short term use where you're moving cross country and you might need 2 to 3 months in a unit. College students coming and going every twice a year. So there are these sort of non-economic drivers that underpin storage demand, and that provides a level of insulation from systemic sort of cyclical activity in terms of demand that impacts sectors like retail, office, industrial, what have you. So that's one aspect of storage that I think is a great attribute and a differentiator. One other thing is from a landlord perspective, there are very favorable protections for landlords in the form of lien laws in most states. And so unlike an apartment tenant or a retail tenant that's delinquent and requires a lengthy judicial eviction process, in self-storage, and this was made apparent or popularized through some of the reality shows on storage auctions. But in the storage world, landlords can simply, through the lien rights that we have on the contents of the unit, simply auction the contents, and the unit is back in inventory the next day. Broom swept, and there you go. So there's no expensive eviction process or eviction moratoriums per se, or tenant protections in the storage world. So we have a lot of latitude from an operational perspective as landlord to deal with delinquencies as low as they are in our business. That's a very powerful, sort of landlord skews very landlord friendly in that department, and that's a big differentiator. I think Joe mentioned low operating expense ratios relative to other property sectors, and when you think about like the physical plant of a storage facility, the most important thing to remember is that there's really no plumbing. And as someone who I've managed large portfolios of apartment, and I can tell you that plumbing is the single biggest issue that causes maintenance problems, and any sort of hobby landlords or people that own a couple of income properties could tell you the same thing. The plumber is really not your friend. So there's no real plumbing per se to break or to flood units. There's very little wood to rot or become termite infested. These are metal and concrete structures that are very durable and low maintenance. So the operating expense ratio and the repairs and maintenance budget relatively low. And so that helps give us a lower break-even occupancy level than other sectors. And it takes longer for us to get into trouble with debt service coverage as occupancy declines. And so that's one of the reasons the sector was fairly resilient during the global financial crisis and had much lower default rates on debt than other property types. So those are a couple of things, a couple of big differentiators that come to mind. And perhaps the biggest one from a value creation perspective is that we have very short duration leases in self-storage, similar to hospitality. And so when, as an investor, if you are a skilled operator and an investor, you can identify mispriced assets that have trapped value in the form of below market leases. And because we're not tied into long-term contracts, as other property types are, with, for instance, an industrial warehouse where you might have 3, 5, or 10-year lease structures, with 30-day leases, we can immediately go about the process of escalating rents from below market levels and driving revenue growth right out of the gates. In a value add sort of strategy, buying undermanaged assets where you've identified a rent roll that's below market. That is a huge opportunity to go in and drive, operator created value. Whereas, there's market driven value creation in the form of kind of general inflation and cap rate compression. Those things help operators, but we have a lot of power to kind of make our own luck in the storage world, because we can go after assets that have underperforming rent rolls, basically, and through algorithmic or sophisticated pricing models similar to what they use in other services where they're repriced daily, like in the airline industry or in the hospitality industry, where they use algorithmic revenue management tools. We can turn an asset over to our revenue management team and extract a lot of value very quickly rather than waiting for leases to roll. So the short tenor of leases is a huge macro sort of attribute of the sector that makes it very attractive and allows us also to track inflation very well, because again, we don't get locked into below market leaseholds with our tenants that are unfavorable. That's sort of at the asset level. As an investment class, there's a lot of data that says that self-storage performs over a long period of time with a really compelling risk-adjusted return ratio. So if you look at the combination of volatility or standard deviation in the returns, the level of sort of instability of those returns over time, combined with and plot that with the return, that scatter plot looks really interesting for the self-storage sector, using the publicly traded storage companies, the REITs, as a proxy for the whole industry. And so when you look at data going back 10, 20 years, storage is performing with a really compelling combination of risk and modest or low return compared to other investable asset classes. And that's not something we made up. That's something that we examined in our efforts to understand where storage belongs in an asset allocation matrix in terms of risk and return relative to other broad equity and debt indices. So that's wearing my allocator hat, that's something, and my investing hat, that's something that gave us a lot of comfort in creating this fund and trying to basically craft a really exciting income product that we could offer to individual accredited and family offices to allow them to access the sector.
But I guess I'd like to hear more about, since we touched on the pros, can you perhaps speak to what, if any, are the cons of investing in self-storage real estate relative to real estate in general? And as an additional question, when will the US, and this is a potential con, reach saturation for self-storage, for their self-storage needs? Are we there yet? Are we close to being there yet? I see self-storage units all over the place here in Madison, but maybe that's not the same situation elsewhere, for example.
Yeah.
Can we say
Yeah,
that there are
I mean-
no cons? No, I'm just kidding. You can cut that out.
No, you actually you hit on the very thing I was going to try to unpack a little bit, but it's a bit of a so saturation is a threat to an individual asset for sure, but not to the sector more broadly. Self-storage performs at the asset level similarly to grocery anchored retail or senior living facilities, in that they the success or failure of an individual deal really depends primarily on the attributes and the relative strength of the trade area for that asset. So the industry rule of thumb is sort of like your trade area is a 3-mile radius around the asset, or maybe if it's a rural market, you might go out to 5 miles. In New York City, you might go to a half a mile, but it's somewhere around 3 miles on average. And so when evaluating, saturation at the asset level, we look. So the con is that the con for the sector, the biggest risk to the success of a deal or a pro forma for a deal is the fact that the sector can be very sensitive to supply shocks, or an asset can be very sensitive to supply shocks because it's arguably fairly commoditized as a product in the consumer's mind. And so if you have a store in your little 3-mile radius market that's doing okay, and then let's say a large public REIT comes in, buys a piece of dirt and builds a 100,000 square foot competitive store a block or two from you, which can happen if you don't properly underwrite the barriers and the land use, situation around your site. If that happens, what they'll do is typically, because they have an empty store the day they get their certificate of occupancy, they offer rents that are half of market. So now you're competing with a brand new store that is priced at half of what rent was in that submarket. And so what you can see is rents drop. If that happens, if a supply shock like that happens at the asset level, you can see rents get cut in half, and you can see occupancy diminish as that new store, which is going to be in lease up for perhaps 2 to 3 years. It's a self-storage facility can have 500 to 1,000 discrete units to rent up, and that can take 2 or 3 years to get to truly get to stabilization. So while they're going through that lease up period, they will be extremely aggressive on rent, and you can get badly impacted by that as an in-place operator, and that can disrupt a trade area. And so that's a con, but we spend for those reasons, we spend an enormous amount of time on market research, and we understand not only what's in a trade area, but what's in planning and permitting at the city. So at the city planning office, we'll go in and get a profile and assign a probability weighting for every project that's been proposed to the planning department or is going through permitting. we'll assign a probability weighting to that and sort of add that probability weighted new supply to the existing supply per capita. And then we also look at the land, the developable land around our subject target asset, and get a feel for the degree to which someone could build a new store during our hold period, our hypothetical 10-year hold period. And if it looks like it's, extremely easy to get storage entitled and built based on available land and very permissive entitlements, entitlements at the city level, will probably pass because of the risk of that location. What we like to see are defensible barriers, a level of existing supply that's at a level that's either indicates undersupply relative to the demand or equilibrium. And so you're right, though, saturation is extremely dangerous oversaturation is extremely dangerous to an individual asset. It's less meaningful at the level of as a national metric. I think we're somewhere around 7 or 8 square feet per capita at the national level. Major markets vary from 5 to 10, and different markets can bear different amounts of supply based on unique attributes of those markets and the way houses are built. For instance, in the Northeast, most people have a basement, which drives down the sort of equilibrium square foot per capita of storage that's typically accepted to around 5 square feet per capita. Whereas in some other markets that don't have basements and where there's a more transient population, like Phoenix, for instance, we can underwrite sometimes to an 8 to 10 square feet per capita in a trade area. And so oversaturation is something that happens in every development cycle, and certain markets can get overbuilt. And that makes for good headlines in the trade journals and such, and it is something to be concerned about. But it's really a micro market business, like, as I said earlier at the outset, like grocery anchored retail, where you want to understand the number of people in your trade area, the household income, kind of the stratification of those people into demographic cohorts, because millennials and boomers and Gen X all use self-storage and participate in the sector a little bit differently. So we kind of take that sausage and look at, put it all together, and we figure out what the implied demand is based on the sort of demographic stratification, and we get a pretty good feel for what we think the demand will be, the equilibrium demand. And going back to that sort of basic formula, if we see that that trade area is undersupplied or at or close to equilibrium, we'll probably pass it on to the next level of analysis. But if it doesn't pass those screens, we are very quick to throw it away, because it's a big country. We have a very broad brush that we can paint with from an investment footprint, and it's not the time right now to be taking risks, because there's a lot of capital trying to, as I said earlier, migrate into the sector, and we generally don't want to compete with those types of buyers. So saturation's a major risk, but I see it as an asset level underwriting issue, and less so of America's going to get overbuilt with storage. That does make for good headlines, but I think it's that's not the risk. I think, but broadly speaking, the participation, this is a good sort of segue, I think, into some of the tailwind that the sector's gotten more broadly from the pandemic. The participation in the sector, as I alluded to earlier, it has never been higher. So all the public REITs are running at about 95% occupied across, thousands of stores, and probably the top five the top 5 operators represent well over 1 million tenants probably. And so they're 95% full. So they have a lot of pricing power. They've never been this full. And a lot of that is a tailwind from the pandemic, some of which I think is going to be really potentially a long-term or long-lived shift in consumer behavior towards more utilization or more participation in the sector. And if you think about, you think about a lot of households, the changes that they had to make to the way they utilize their homes, their primary residence during peak COVID years or peak COVID time, when they were maxing out every square inch of utility in their house, for a home office, for schooling their kids from home, for a home gym, potentially in the garage, just really more intensively using their house. That created, I think, a new set point, a higher set point for square foot per capita demand for the product, for the service, that may not burn off anytime soon. I know, I have, for my, wearing my consumer hat, I took a unit, I took a 10 by 10 when we were remote for 18 months, and I used one of our bedrooms as an office. And I don't know if I want to give that up because it's a nice satellite office for me and a place. And also we made one of the bays in our garage into a gym with a treadmill and a rowing machine. And I don't know that I want to give that up either because of the convenience. But I think, I think some of that pandemic driven higher set point in demand is going to continue. And may never really fully abate. I mean, hybrid work from home schedules will probably stay with us for the rest of our careers.
Makes sense. And, honestly too, Lloyd, it's a lot cheaper to have a storage unit than do a remodel, right? and add a space to your house for that gym and
yeah, that's true.
The office. I mean, it really is if you think about it.
You're exactly right. I mean, consumers are seeing that self-storage is a service that one of our marketing hashtags is make room for awesome, but it does allow you to there is a certain amount of clarity and happiness that comes from decluttering and having more space for the things that really matter in your home. And whether we could argue for a long time about whether or not people should be putting some of the things in storage that they do, because they're basically, they don't have much value. And so it might be better served to put some of that stuff in Goodwill. But consumers are pretty sentimental, and they attach non-economic value to a lot of things. And so they go into storage. And for that reason, that type of tenant tends to be fairly sticky. Yeah.
Okay.
Good point.
Yeah, it's a very interesting, and I might be shifting gears a little bit here, but I kind of want to get back to your ideal client or investor, like who the two of you are looking to invest within this fund, and who that may be, and what would be kind of an ideal situation for the fund and for the group.
Investors that are looking for stable, low, stable, like, uncorrelated or low correlated real property assets with current cash flow and long-term capital appreciation will find this interesting. I think it has a place in a lot of different types of portfolios. We set our minimum fairly low at 250,000 to make it appealing to, I think, a broad swath of individual accrediteds and sort of small and middle market size family offices to get in at that price point. And because it's an open-end fund, you can sort of dollar cost average in and leg into a larger position over time if you like the way it's working and just want to accrete a larger position over time. But yeah, I mean, if you're a taxable U.S. investor, the current income is tax efficient in that it's got that what the revenue service calls Section 199A deduction. So it's a private REIT pass-through deduction on the current income. So it's only 80% taxable, and that lowers the effective tax rate. But it's really just a good combination of current income and long-term growth. And especially for those that are thinking about how do I replace my income over time. This is another source of relatively insulated income that has low beta, so low correlation to systemic market risk. Self-storage. We've looked at back testing some of our performance through the global financial crisis, and self-storage, as measured by I think it was a 14 asset same store pool that we tracked from the peak to the trough to the peak in the GFC. Self-storage, at least in the context of that analysis, if you believe this increasing volatility is the way of the future, and you want something that's relatively modest in terms of its volatility or its beta, our portfolio pulled in about 10 percentage points on occupancy from like 90% to 80% before it made a quick recovery. And that was the global financial crisis. So a very deep and long-lasting cyclical move. I think it has broad appeal to investors that are looking for tax efficient cash flow, looking for long-term growth, looking for income replacement as they approach retirement or semi-retirement. We're going to be paying a quarterly dividend.
Got it. Okay. Joe, did you have anything else to add to that?
I think if somebody's core business isn't real estate, right? If their bread and butter is real estate, then obviously they can go direct with their own business. But for somebody who thinks, where the market is right now, fixed income doesn't look great. I don't know if you're catching a falling knife investing in equities right now. I don't know if anybody knows. And all we're doing is reading about, is this going to be 5 years? Is this going to be 6 months? No one knows. And you want to get exposure to real estate, but it's a real undertaking to go out and buy an apartment building or buy a warehouse or buy your own self-storage facility. To get exposure to one of the best operators in the business, let alone in self-storage, and to kind of dip your toe in the water, to all of Lloyd's points, it's something that's like a fixed income replacement. You're getting exposure and you're learning about this asset class. It's a wonderful tool to diversify in your portfolio in terms of an alternative.
Okay. That's going to be, you led me into my last question that I have before we go into close and having kind of giving our final thoughts. But so you're telling me that everybody listening shouldn't just go buy storage units themselves, right? That's not what you're saying? Like, just go ahead and start buying it up and trying to roll up, or like, what are your thoughts on that?
They can.
Okay.
It's I'd say, maybe I'd put it this way, and maybe Lloyd would agree with me. To operate a self-storage facility, I think to be a C player is doable. I think to really not get over your skis in terms of what he was talking about with our market research, right? Like, what MSA do I want to be in? Who has the dirt across the street? Is there job growth? Is there population growth? Because we're looking at markets where people are moving to. So even that level of analysis, and then going into, real sort of AAA operator improvements and understanding what that entails. I think, again, this gives you risk across multiple assets and backed by one of the best operators in the space. If you're a real cowboy and you want to go out and buy self-storage, you want to get your uncle to loan you half the down payment and you got the stomach for it. All the power to you. But again, if you're trying to dip your toe into the space and get some exposure, learn about pro formas and K1s and how things report, and that's phase one before you go out and say, I'm going to go buy this thing I found on LoopNet, then probably a good opportunity for you.
Got it. Okay. Well, I think too, it's time for us to probably wrap up. And like we always like to do a round robin. I can go first. I'll toss it to Nathaniel, and Nathaniel, you can pass it to whoever you'd like. I think the two things that I really kind of pointed out to me from the conversation, one is a non-correlation in a lot of ways. And I like kind of how Lloyd brought it up with the consumer behavior and how that is very hard from an economics perspective to put a value on, right? People put things in storage units that may have no economic value, and they're spending money to preserve something that may not have economic value. But there is qualitative value qualitative value, which is important to the individual. And so it kind of just paints a picture behind storage units in general, but also going back to the consumer behavior change in the sense of utilizing their space, the utility of their actual home. And it is a lot cheaper to have a storage unit relative to doing a remodel, especially with where prices of lumber and everything else have gone. So it's just a really interesting standpoint of how the pandemic really affected just your specific industry in a lot of different ways, and how it could change, not even just for the last few years, but going forward, and how other individuals interact with that type of a service. And the other thing that I really has been really interesting, just meeting the two of you in the company, is your vertical integration and the operating. That to me fascinates me, that you have a lot of the building blocks to make a very informed and aware decision on certain investments and types, and gathering that information all in house, because you can get those communication streams all vertically integrated, which is quite awesome when I look about it from an execution perspective. And then the time that you have been in the business has been a long time. This isn't that you just jumped in yesterday and built this portfolio. It's been over a couple decades with all of that experience. So it's really interesting to hear coming from the horse's mouth, per se, to just hear about the storage units, because I think that Joe's right, that you see a lot online where storage units kind of become hot, and it's like, oh, well, it's an easy asset to own. And whenever something is easy, that means you don't understand the nuance, probably. And I think there's a lot of nuance to this specific space. So we really appreciate you sharing those thoughts. Nathaniel, go right ahead.
I'm going to hit on three things. One, Lloyd, I really liked your comment about how the fact that most of these places you don't have to worry about plumbing. And that's your single biggest issue as a landlord for residential or multi-residential units.
Yeah,
it's amazing, because it's such a simple thing, but it can be your biggest issue. And I think that a lot of people who are investing, who want to invest in real estate, they don't think about it in those terms. They think about that they're buying this big asset with leverage, and then they're able to get somebody to rent it to, and then they're paying off that leverage, and it's not them, it's the renter, and they get, oh, I'm making some money, and this asset value is going to increase with time on top of the leverage being paid off. They're not thinking about the biggest problem is going to be plumbing. And then the other thing that I wanted to hit on was hearing your detailed analysis about saturation as a risk, and going into the detail about both the macro and the micro, and how it can depend, and the national and the local. They're two very different things, but these are things that within them there is a whole host of other factors that shops such as yours are going into great detail on, to then determine where you should be purchasing and maybe selling assets as circumstances change. And I think that a lot of investors or potential owners of such assets don't go into that kind of level of analysis, which I think is just speaks to the power of understanding your niche, which I think is a power unto itself. So with that, I think I'll go to Joe so that we can leave Lloyd for last.
For me, I sort of have an interesting path to the firm, and getting to work with Lloyd and getting to work with the rest of the team here, and obviously learning, and my sort of skill has been raising capital previously in a totally different sector. But I sought out this firm, right? I was making a pivot, and I really liked storage. I liked industrial. I sort of like things with utility to them. And the more I had heard about Bill and the firm from various friends, an industrial developer or a bridge lender, it was this name that kept coming up in this space. And so for me, I'm very lucky and very blessed to work where I am, because I'm surrounded by super smart people from the market research team, the acquisitions team. I get to work with Lloyd. We have a super dynamic CEO who's built the company from the ground up. And, I wanted to work for a great operator. And so I get to do that and sort of get the best of both worlds, which is learning everything from, acquisitions, ground up development, third-party management, all that goes into it. But at the same time, being able to do what I love, which is, work with capital partners and raise money and, love talking to people, love asking questions, getting to know people. And I think that I'm very blessed to kind of sit in between the two. So.
Well, thank you guys for this forum. It's been really fun, just sharing our thoughts on the sector and some of the sort of macro and micro factors that have been driving it forward and make it very appealing. I came into the self-storage sector from a multi-property sector fund, and one of the things that really drew me to storage was it's an incredible asset class for so many different reasons, and it sort of flies below the radar. But it's one of those asset classes that it's low volatility, it's stable cash flow, it's a long history of capital appreciation. There's just so many incredible attributes of the sector, and when you combine that an incredible sort of under the radar sector with a very bankable sponsor, been in business for 25 to 30 years now, full vertical integration from finance to construction to acquisitions to operations to revenue management. It's really an incredible combination that makes this a compelling product that Joe and I are really excited about working on and building this fund. So yeah, the future's bright. I'm really excited about continuing to grow and partner with groups like yours, and that's I will leave it at that.
Perfect. Well, Joe and Lloyd, thank you for both joining us today. We really appreciate it. It was a fascinating conversation. And thank you to our listeners and our viewers for listening to a few people talk about things that they love. And we will see you next time. Thank you.
Nice.
Thanks, guys.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.